Hi, everyone. Thank you so much for joining us today. Today our webinar is sales tax versus income tax. This is a 90-minute webinar. Thank you so much for joining us. And before we get started, we're going to go over a few housekeeping items, and then Mike will jump right in and we'll put as much information as we can in this. So first and foremost, if you are here for CPE credit, you do need to do a couple things in order to receive that CPE credit. You will need to answer the poll questions as they pop up on your screen. Today, there are 5 of those. And you will also need to answer the survey at the end of this webinar. So this webinar will be 1.5 CPE credits, and give us a couple business days and we'll get those out to you. A couple other important things to take note of here. If you have questions as we are going along, please reach out and ask those questions. We are going to do our absolute best to answer them at the end of this webinar or follow up with you via email. But you can just wiggle your mouse around and you'll see the Q&A button on the bottom of your screen. And you can submit your questions again anytime during the webinar. We also will, oh, we also will be sending out today's slides once we get the ball rolling here a little bit. Sorry, my screen's having some issues, but I'll go from memory. No worries. So once we get the ball rolling here a little bit, I will be linking today's slides in the chat feature. They're also already uploaded to Zoom and will be uh, sent to you via email in 24 hours, along with an additional link to the survey. A couple more things here. We have pre-recorded CPE available in our Salt Vault. You can also purchase those one-off. There's also in our Salt Vault an entire list of things. Here's just some of them on the screen. If you have questions about that, please reach out to me. I'm more than happy to answer any questions that you might have. And let's do some quick introductions here. So first, for Sales Tax and More, we are a full-service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, and like our name states, more. So if you have questions about our services or you'd like to work with us, please reach out. We'd love to hear from you and we'd love to work with you as well. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well rounded, and he has helped thousands of companies of all sizes and in all industries, and is especially well known for his work in the e-commerce industries. And Mike, since my notes went down, if I forgot anything, please fill it in, but I think we're okay to get started.
You did a great job. Thank you, Ellie. And welcome, everyone. Thank you for joining us today. We've got a lot of information to cover, as always. And here are some of the points that we're going to go over. We're going to start with a definition of nexus. We're going to talk about sales tax nexus, not as in-depth as some of our other webinars. We talk a lot about sales tax nexus. We're going to really concentrate more on income tax nexus today. And no conversation about income tax nexus could be complete without Public Law 86272. It's a federal law. And we're going to talk about the Multi-State Tax Commission's historical guidance when it comes to Public Law 86272, and then their current guidance. And then we're going to talk about some aggressive income tax states, and then we're going to open it up to questions. So what we hope everyone will walk away from today is an understanding that there are different nexus standards out there. Understand the protections of Public Law 86272, as well as the limitations of Public Law 86272, and then understand where you or your clients may have exposure and where they don't have exposure. As always, the worst time to find out you have problems or that your clients have problems is when they're being contacted by a state, whether that be a telephone call, whether it be an email, whether it be snail mail, whether it be a Nexus questionnaire. The reason why it's the worst time is because there are programs out there that will help mitigate some past exposure, but most of the time, not all of the time, but most of the time, those options are off the table if you've already been contacted by the state. And the state keeps great records. we'll get into like a voluntary disclosure agreement and ask our client if they've ever been contacted by the state, and they say no. And VDAs are done on an anonymous basis. And once they tell us no, we make sure we can meet the rest of the conditions. We disclose to the state who our client is, and our client says, excuse me, and the state says, oh, well, we contacted this client 2 years ago at 6 o'clock, or probably not 6 o'clock, 4 o'clock in the afternoon, by telephone. They keep very good records. So at that point, they weren't allowed to go into the VDA. We had a scramble. And luckily, we got them into a managed audit. Not quite as good as a VDA, but still protected them because now the state has all of their information. And so you want to make sure that you haven't been contacted by the state. The state keeps good records. And it's why you want to be proactive, because you want to mitigate any of this past exposure if you possibly can. All right, Ellie, why don't we go to the first polling question?
Absolutely. That should be up on everyone's screen right now. We want to know how you would rate your own Nexus knowledge. And so your choices are, the basics, you have intermediate knowledge, the basics again, or you are a Nexus expert, or like, as we like to say, an expert. And Mike, it looks like we have a really good mix of who's out there today. I'll leave this open. You can move forward and I'll close this out in 30 more seconds or so. Um, yeah.
So is that second basics question, is that like the advanced basics?
Yeah, it's the advanced basic. It's a super secret basic option. It definitely, yep, that's exactly what it is.
All right. I see we have a couple of Nexus experts out in the audience today. That's great. This way they can keep me honest. Um, all right. So for those of you who may not, who may be beginners here, let's start with a quick definition of Nexus. It's just a fancy word, means link or connection. And when we're talking about taxes, it's the link or connection that has to be present before the state can require you to do anything. Before they can require you to collect a tax like a sales tax or a vendor's use tax, or paid taxes like an income tax, a franchise tax, or a consumer use tax, you have to have this link or connection that we call nexus. And it's why we say it all starts with Nexus, because if you don't have this link or connection, then the state can't require you to do anything. So no Nexus equals no problems and no responsibility. Now let's start getting into some sales tax nexus here. We're going to talk about economic nexus first. This is came about as a result of the Wayfair case, Wayfair versus South Dakota. That was a 2018 case, and the state won this case, and the Supreme Court said, yes, South Dakota, you can move forward. So as a result of this case, you can now have nexus with the state without any physical presence. Prior to that, we can argue over what that physical presence was, or what constituted a physical presence, but you had to have some sort of physical connection with the state. Now it can be based solely on sales, can be based on transactions, or it can be based on both. New York and Connecticut use the word and rather than or. Um, South Dakota thought $100,000 or 200 transactions was fair. A lot of states jumped on the bandwagon. We're seeing a big move away from transactions, but they're still important. Somewhere just north of 30% of the states still have transactions, some of them very big, very aggressive states like Illinois. Whenever I say we're seeing a trend away from transactions, people say, oh, I don't have to worry about that anymore. No, you do. Um, so it's positive. It's moving in the taxpayer's favor, but we still have to count that in a number of states. Some of them, like Illinois, like I said, is very aggressive. States don't ever make anything easy. What's included in these transactions is different on a state by state basis. Um, when it comes to states with a sales tax, they have all implemented some type of economic nexus at this point. Missouri was the last state to become effective. It was January of 2023. Even Alaska, they have an economic nexus. Now, there are no state taxes in Alaska, but there are local taxes. The boroughs and the municipalities, and they all banded together. They formed the Alaska Municipal League, and they're the ones who uh, administer the local taxes. And it used to be that if you had $100,000 or 200 transactions in the state, then you needed to collect for these local municipalities and boroughs. So I'm having a tough time talking today. But that just changed. On January 1st of 2025, they did away with the transaction threshold. So you know, if you were only registered in Alaska because of this 200 transaction threshold, you can now deregister. Some states make you wait until the trailing nexus is up, and trailing nexus is uh, a concept that says that you have nexus in our state for the 12 months, or you need to stay registered in our state for the 12-month period following when your nexus ended. So Alaska was nice when they did this. They went ahead and they said, no, you can deregister right away. You don't have to wait out any period. Um, I want to let everyone know this is not an internet issue, this economic nexus. Um, it's a multi-state issue. For example, you don't even have to have a website. You could be selling entirely by telephone. You can be selling entirely by referral, by infomercial, by catalog. It doesn't matter how you're selling. If you have sales into multiple states, this could impact you and or your clients. So definitely not an internet issue. Now, the other thing is, we're 6.5 years into this now. I still get calls. People say, hey, Mike, I want to deregister in the state of, let's say, Alaska, because they just did away with their transaction threshold. I say, okay, well, last time we spoke, you had independent contractors that were traveling into the state of Alaska on your behalf. And they say, well, yeah, I still do, but I don't have this 200 transactions and I'm under $100,000 in sales. Well, unfortunately, at that point, I have to break it to them and say that, when it comes to sales tax, economic nexus doesn't protect you from any other type of tax. As a matter of fact, a physical nexus is going to override an economic nexus in almost every scenario. Um, I get calls, about Texas. There are no transaction thresholds in Texas, and it's a $500,000 uh, limit. And people will say, or California, same thing. And they'll say, well, Mike, I want to deregister. I'm not over the $500,000. And I'll say, okay, well, last time we talked, you had some inventory in the Amazon warehouses in California. So, unfortunately, California views that as nexus creating, and it's going to override this economic nexus. So, um, this doesn't protect you. It's just one more way for the states to get you to do what they want you to do, which is collect and pay their taxes. All right, we've got a chart out there. This is going to be one of your handouts today, and it's also on the free portion of our website. We keep it updated. As you can see, 1/3 is the last time it was updated. That was because of Alaska. And I'm sorry, I just looked at Alaska there. We've got to correct the formatting on it. But as of April 1st of 2020, they had a 200 transaction threshold. As of 1/1/2025, it's not, uh, uh, it doesn't matter. So this chart is great. I mean, just about every software company out there, every platform is going to tell you, oh, well, we can automatically tell you where you have Nexus and where you need to register. Well, invariably, you're going to end up getting registered in too many states. That's how it usually happens, or not enough states sometimes, but usually you get registered in too many states because all of these software programs, they don't get granular enough. So once you hit a certain dollar figure, they're telling you you need to go out and get it registered everywhere. But they're not looking at what the state actually includes in that threshold. So the middle of the page there, it's going to tell you whether they include sales through a marketplace like Amazon or eBay. Um, it's going to tell you if they include or exclude sales for resale and then exempt sales. So you'll have some states that say, well, we're going to exclude sales for resale and marketplace sales, but we're going to include all other exempt sales. Some states say we include absolutely everything, exempt as well as taxable and sales through the marketplace. So each state, they don't make it easy. They do it a little bit different. This chart is an invaluable tool, or something like this chart is an invaluable tool for you. Because as I said, take Shopify. Shopify just looks at the numbers. They don't look at the rest of this information. So the software out there, it's a great red flag. It'll tell you when you should really be checking on things. But then you got to look at your specific fact pattern, because when you go through it, you may find out that, oh, well, I don't count this in this state. I don't count this in this state. I don't count that in this state. And people come to us all the time and say, hey, Shopify needs to says I need to get registered in 25 states. And I'll go through it and I say, well, based upon this here, looks like you only need to get registered in 4 or 5 states. So, you know, usually you're going to end up getting registered in too many states if you're just going off of this software. Now, every once in a while, you're not going to be getting registered in enough states because maybe you're not putting your marketplace sales into Avalara or into whatever. So they're only looking at part of the information. So the software, it's a good tool, but you really got to be doing some follow-up, or hire someone like us to do the follow-up with you. When it comes to Economic Nexus, we've got a real, we call it a data review. It's a pretty inexpensive. It's $7.95, and we'll go through the last 2 years and let you know where you can register, where you should register, how you should register. And then if you need to deregister or can deregister, we'll let you know that also. And there's other great information in here. What type of tax should you be registered for? We see a lot of problems right now with people getting registered for the wrong type of tax. Or when they call the state, they're using terms that don't match up to what the state's using. So there's a lot of confusion there. Like in Alabama, the simplified seller's use tax. That's the one you want to be signing up for, not the sales tax. So you got to know what type of tax you want to be getting registered for. And then what the period is. How soon, once you cross Nexus, are you supposed to be getting registered? So a lot of great information on this. And by the way, if you look at that fourth column, what time period for the threshold? What's it based on? And a lot of states say the previous calendar year. So January is a great time to be checking your Nexus footprint, because you look at the previous calendar year, January through December, and if you're over the threshold, then you may have a responsibility to collect and remit tax. So you should get registered. Um, but if you're not over that threshold, you can wait until the following January. When it comes to other states, they say previous or current calendar year. Well, if your sales are growing, at a 10% rate, well, you maybe can just wait until the following January anyway. But we've had instances where there was this one company, they were on Shark Tank and their sales exploded. And it was the month of April, and they didn't give us year-to-date sales. We were looking at the previous year's sales. And I told them they were a small company. They were registered in 2 states. I told them, I don't know, you have to register in another 3, 4 states. And the salesperson came back and said, "No, Mike, their sales are exploding. Um, you know, I think that we need to relook at this." I said, "Okay, well, send me the year-to-date sales." And when they did, my recommendation was another, 16. Well, altogether, they were had to be registered in over 20 states at that point. And it was only April. So they gave me, the first 90 days of the year. So if your sales are exploding, then you might have to look at this more than once a year. And then there are the states that say, like Illinois says that it's a rolling 12-month period and you need to check this every quarter. So January is a great time to do it, but you may have to do it more often than just January, depending on your uh, actual facts and circumstances. All right. So South Dakota was pretty smart. They said that we're only going to do this, we're only going to enforce this from the effective date. So in other words, they're going to do it going forward. They're going to do it prospectively. Um, However, those effective dates are getting old, 6.5 years at this point for some states. So you don't want to procrastinate. And a lot of people say, well, I didn't know about it, so I'm just going to register going forward. I want to stop the bleeding. And in a number of states, they don't check the dates that you put on the registration forms. So you can get away with something like that. But in other states like Arizona and Arkansas and Illinois and Wisconsin and Maine, they're actually auditing registrants. Now, not right away. They'll let you get registered. They'll, maybe 6 months down the road. Usually I'm seeing it 2, 3, 4 years down the road. They're coming back and saying, "Hey, we think you used the wrong date based upon your sales, and now we're going to audit you." We expect to see a lot more of this. And it's not they're auditing one or two companies, they're auditing everybody. So you got to really either do a historical registration or a VDA in these states, in my opinion, because it's not a matter of if they're going to contact you, it's a matter of when they're going to contact you. Other states are getting pretty aggressive. Alabama, Kentucky, Utah. There are a number of surveys out there. These surveys are kind of old, but they're 2 to 3 years old at this point. But I still think the number of non-compliant companies is right around 50% because some companies went out and they did it, but they didn't stay on top of it. So as they're crossing more thresholds, they're not staying, compliant. They're not adding additional states. It's just what they added when they first checked on this. So this is, and there's some companies that, believe it or not, that still have not heard of this. So I think that that's really important to understand because the states know this, and the states are going to be coming after companies. They're going to start making examples of people because it's almost like shooting fish in a barrel. All right, so let's talk about physical nexus. And when we talk about physical nexus, the one issue that in all my years of doing this has created the big problems is what we call third party nexus. And, if the reason this is such a big issue is when we're thinking about what activities we have that might create this link or connection with a state, we don't think of the people that we work with or that we ask to do things for us, third parties. It just doesn't make common sense. So that's why this has become such a big issue. There are two U.S. Supreme Court cases about this. We've got Scripto, which is um, it was a Georgia company. They were a pen company in the state of Florida, and state of Florida said, "Hey, these 10 independent contractors, they're creating a significant nexus for you in our state." And Scripto said, "You're out of your mind. That's not creating any type of significant presence for us. These are true arm's length transactions." Well, unfortunately, the U.S. Supreme Court disagreed, and they said it's constitutionally insignificant as to what you call on these people. They're doing the same job. So, yes, third parties can create nexus. We saw this tested again in 1987 under Tyler Pipe. And the Supreme Court, in this case, they came out and the language they used, I'm going to paraphrase, but the second part's really important. The first part, they said it doesn't matter what you call them, doesn't matter how you pay them, doesn't matter if they represent you exclusively or if they represent multiple parties, doesn't matter if they do it on a full-time or part-time basis. Here's what's important. Are they helping you to establish or maintain a market? And if they're helping you to establish or maintain a market, then yes, that can create nexus. And the reason why that language, helping to establish or maintain a market, is so important is because the states picked that up and ran with it. And they incorporated it directly into their statutes, their rules, their regulations. They use it to provide guidance. The state courts use it as precedent. So really, really big issue because it just doesn't make common sense. We don't think about how third parties can create a link for us. And it's not, all third-party relationships. They have to be helping to establish or maintain a market. So here's a partial list up here of some of the activities that do this. Rather than get into all of them, I'm going to tell you what we tell our clients, which is if you're sending someone into a state to talk to your clients or to talk to the public, then that's generally going to be helping to establish or maintain a market and therefore can create nexus. However, let's say that you're hiring someone on a 1099 basis to develop some software for you, or maybe they're doing your books and you're paying them on a 1099 basis. Well, they're not helping to establish or maintain a market, so those types of activities do not generally create nexus. All right, so here's another tough one. Where you have employees' locations or where you live or operate your business from. Nowadays, I hear a lot of, well, Mike, I do everything in the cloud. Everything is virtual. I don't have any of those things that you're talking about. Unfortunately, the state doesn't see it that way. They say where you live creates a link with the state. Where you live is going to be where you're operating your business from. And employees, this has become a bigger issue because during the pandemic, they suspended this when everyone had to work from home. But the pandemic has been over for a number of years now, and the states have sunset all of their, temporary waivers of that creating nexus. So where you have employees, locations, or where you live or operate your business from, real big one. Here's a list of 10 common nexus creating activities for sales and use tax. And when I say these are common, it's most states or all states look at these the same way. And that's in direct contrast to the 12 state specific nexus creating activities. And in this, maybe only one state looks at this as a nexus creating activity. But in general, it's going to be a handful of states. Trade shows, there's lots of different ways that states look at it. By the way, everyone likes to use the term de minimis activities. Well, that's de minimis. Well, the states don't really define de minimis, so it's real hard to get out of doing something that the state wants you to do by claiming a de minimis exemption, except for trade shows. There are a number of states out there that actually define de minimis activities when it comes to trade shows very well. But it's going to be different on a state-by-state basis. By the way, both of those sheets are up on our website and they should be handouts today. So just a sales tax nexus summary. Physical nexus, still alive. A lot of people think that, hey, now that we have economic nexus, we don't have to worry about the physical nexus. And unfortunately, it's bad enough if the state finds you for economic nexus and you've got 6 years worth of exposure. What happens if you've had third-party relationships in these states that create nexus for 10, 15, 20 years. So physical nexus is still alive and well. Number two, economic nexus not going away. The states, for the most part, have implemented it very well. We may see some cases like in Illinois where they didn't implement it very well. I think that they got a constitutional issue there, but it's too easy to fix. So, and states have been known to go back retroactively. So we advise our clients to go ahead and continue filing in Illinois. Economic nexus not going to be going away. It's here to stay. A lot of people thought that Congress was going to step in. I don't think there's any appetite for that. And by the way, when we get to income tax, you'll see the last time that Congress got involved in a nexus case was 1959. And at that point, they said, this is just a temporary law. And we are going to have to do studies and, empower panels and commissions and figure out how to get our arms around this nexus question. So this is just temporary. Once we have all the answers, we're going to go ahead and give you something better than this temporary law. That was in 1959. So what was that? 65 years ago? So maybe our great grandchildren might benefit from something Congress does, but I don't see anything happening anytime shortly. And they thought the Supreme Court was going to step back in, and I don't see it with the makeup of this court anytime soon. They're the ones who introduced the economic nexus or allowed it to move forward. I don't think they're going to reverse themselves. So a couple of states, they may have to fine tune. That's why we're seeing a trend away from transaction thresholds, but economic nexus not going anyway. Independent contractors, major risk factor. And inventory is a major risk factor for companies, even when they have inventory in an Amazon warehouse. Even though Amazon's collecting the tax, a lot of Amazon sellers say, well, it's like a consignment sale, so Amazon should be collecting the tax. And I agreed with that. Amazon should have been collecting the tax, and they are now. However, most of the states say inventory in their state, even consigned inventory, creates nexus. Now, since Amazon started collecting, some states have modified, like Arizona says, if Amazon moves it into Arizona, it does not create nexus. If you send it directly to Arizona, it does create nexus. States like Texas say, well, if you're using it just to fulfill Amazon sales, then it doesn't create nexus. However, and a number of companies are doing this nowadays, they're using their Amazon warehouses to fulfill all their sales. And if you're doing that, then it does create nexus. All right, Ellie, let's do the next polling question before we start talking about income tax.
Yeah, absolutely. We have a quick true or false question here. Activities of third parties create nexus if they're helping to establish or maintain a market. True, false, or it depends. And Mike, if you want to go over this quick, I'll leave it open and then you can move forward and I'll leave this open for a little bit more time here.
Um, well, it depends on exactly what they're doing, but in general, this is a true statement. If they're helping to establish or maintain a market, the Supreme Court has said, yes, that can create nexus. And most states, there are two Supreme Court cases about this. Most states say, okay, I'm safe. And they want to have as many nexus creating activities in their state as they possibly can. So the best answer here is true. It depends is the second best answer. All right, so let's talk about some Supreme Court cases as they pertain to, uh, actually, they're not all Supreme Court cases. Well, let's talk about some court cases as they pertain to income tax. And we're not going to do a deep dive here. This first case, Northwestern Cement versus Minnesota, was a 1959 case. This actually is a U.S. Supreme Court case. And the fact pattern here, and this fact pattern is very, very important. We're going to see it come up again and again. The company had an in-state office with salesmen soliciting orders of tangible personal property. The orders were approved outside of the state and then fulfilled from a point outside of the state. And the U.S. Supreme Court said these taxes did not violate either the Commerce Clause or the Due Process Clause of the federal Constitution. And Congress got all up in arms and businesses got all up in arms and they said, oh my, this is horrendous. This is so hard to figure out. It's going to be such a hit to business. We're going to go into another depression. And Congress, this is one of the quickest I've ever seen them move. Within 7 months, they put out Public Law 86-272. So that 86 stands for the 86th session of Congress. A lot of people think it's 1986, but it's the 86th session of Congress. And they passed this Interstate Income Act of 1959, or Public Law 86-272, and it basically nullified the Northwestern Cement opinion. And we're going to come back to this, but remember that fact pattern. Quill Corp. Now, the Wayfair case overturned Quill, but because of the language, the limiting language that was used by the Supreme Court in the Quill Corp, they basically said, at least for sales tax, there has to be some sort of physical presence. Well, since 1992, states have took that to mean, well, if they're just limiting this to sales tax, then other types of taxes, it's okay to have an economic nexus. So we see this in 1993, Jeffrey versus South Carolina, and the South Carolina court said the licensing of intangibles are enough to create a substantial nexus. And they actually quoted the U.S. Supreme Court. And they said, hey, at least for sales tax, that means that non-sales tax is okay. So did not go to the Supreme Court. The next one is another U.S. Supreme Court case, and this is Wisconsin versus the Department of Revenue, Wisconsin Department of Revenue versus Wrigley, the gum company. And this clarified what constitutes solicitation of orders and de minimis activities as they relate to Public Law 86-272. And Ellie, why don't we do another poll question before we start getting into actual nexus?
Absolutely. Another true or false question for everyone here. Um, Economic nexus is not going away. True, false, or it depends. And Micah, this is another one that you'll want to review a little bit, but then again, you can move forward and I'll leave this open so answers can trickle in here.
Okay, so this is really an opinion question. My opinion is it's not going away. There's too much stacked against it. It's fairly well entrenched right now. It may be modified, but definitely not going away. But it's an opinion question. So false could be an answer, or it depends could be an answer. All right, so physical presence nexus. Really the same activities that create nexus for sales tax can create nexus for income tax. In many states, they simply say that any activity not protected by Public Law 86-272 creates nexus. Now, some states are good and they list their protected and unprotected activities, but some states don't. So when it comes to physical nexus, a lot of the states are real good at listing what does and does not create nexus. When it comes to income tax, not as good there. But the same activities that create nexus for sales tax generally create nexus for income tax, unless they're protected by Public Law 86-272. And Public Law 86-272 is the Interstate Income Act of 1959. It was in direct response to the specifics of Northwestern Cement. So that was sales of tangible sales of tangible personal property. The orders were approved outside the state, and then they were fulfilled from a point outside the state. As we said, Congress reacted very swiftly, by the way, meant as a temporary solution. And here's what Public Law 6.272. A state's prohibited from imposing a net income tax. Very important there. State is prohibited from imposing a net income tax. Doesn't say franchise tax or gross receipts tax. It says net income tax if these three criteria are met. The in-state activities do not exceed the solicitation of tangible personal property. So very specific there. Orders are sent outside the state for approval, and then the orders are fulfilled from a point outside the state. Direct response to the Northwestern Cement case. So who does Public Law 86-272 historically protect? Well, any companies, e-commerce companies, they have a pure economic nexus selling tangible personal property into a state with a net income tax. Well, if you're following the historical guidance from the MTC, you would be protected because you don't have any physical presence. All you're doing is selling into the state. So if I'm selling tangible personal property into the state, then I would be protected. And even traditional companies, even when they have independent contractors or employees in the state, if they're only soliciting tangible personal properties and the orders are approved from outside the state and then fulfilled from a point outside the state, then they're protected from the state imposing a net income tax on you. Now, this protected a lot more companies back in 1959 than it does today. I mean, we really have a service-based economy now. Back then, we had a manufacturing-based economy. So big differences. I mean, even before the Wayfair case or going back to Quill case, we were starting to see problems with the protections of Public Law 86-272. So who does it not protect? Well, companies offering services in addition to selling tangible personal property. And by the way, it's not, you don't get to prorate it. You don't get to say, okay, well, we're selling, 30% services and 70% tangible personal property, so we're exempt on 70% of our income. No, it's all or nothing. So if you're offering services in addition to selling tangible personal property, if you're doing training, if you're doing installations, implementations, repairs, well, those are not protected by Public Law 86-72. You would still be subject to a net income tax. Companies with inventory in a state, FBA sellers. So if something has to be fulfilled from a point outside the state, well, if you have a warehouse inside the state, at least some of your orders are going to be fulfilled from a point inside the state. So therefore, it's an all or nothing protection. Companies selling intangibles or services entirely. Companies with a physical presence in the state. And this last one, a lot of states look at this and say, well, this was about interstate commerce. So foreign entities are not covered by this. So these are the companies that are often not protected by Public Law 86-272. Now, the Multi-State Tax Commission, or MTC, they were established by the Multi-State Tax Compact, which is a quasi-governmental agency. The policies of the MTC are advisory only, and they were designed to promote uniformity. And what they do is they develop models and issue guidelines. They also perform audits, which is one of the reasons why I don't think it's a good idea to do VDAs through the MTC. I mean, supposedly the one hand doesn't know what the other is doing, but seems to me pretty risky. All right, so the MTC, some of the guidelines they put out there relate to Public Law 86-272, and they were originally adopted in 1986. They were revised after Wrigley, and that was in 1993, and again in 1994, and 2001, and now 2021 after the Wayfair case. Originally, they identified 13 protected activities, activities you could do that would still allow you to get the benefits of these protections. And they identified 20 unprotected activities. Remember, states may deviate. These are not binding. So they've been revised in light of Wayfair. So we're going to go over the old guidelines and the new guidelines once we get through this next polling question, Ellie.
Absolutely. A lot of true or false question today's for everyone. You must have physical presence to create Nexus. True or false? And we're going to leave this up. Quick reminder, you do have to answer these poll questions in order to receive CPE credit. And Mike, if you want to review this one quick, we can leave it open a little bit longer and then you can move forward.
Yeah, I think everyone got this one right. You don't need a physical presence nowadays, either for sales tax or income tax. So when we're talking about thresholds, though, I want to say this before I forget. Um, we're going to talk about an economic nexus for income tax a little bit further down the road, and they have what's called a bright line. And when it comes to income tax, unlike sales tax, if you're underneath the threshold, even if you have a physical presence in some states, then you don't have to pay the income tax. So very, very different from sales tax. That bright line, if it's under a certain dollar amount, you don't need to worry about it. Not so much in sales tax. Sales tax, you have a physical nexus, then it's going to override that economic nexus. Okay, so historical protected activities. So soliciting orders for sales of any type, that makes sense. Solicitation of orders by an in-state resident or representative of the company, so long as the person does not maintain or use any office or other place of business in the state other than in-home. So if you got an in-home office, then you're good. If you have an office, you're renting office space somewhere, then that does create nexus. Carrying samples and promotional materials only for display or distribution without charge or other consideration. We're going to see that line without charge or other consideration on a lot of these protected activities. So furnishing and setting up display racks and advising customers on the display of the company's products without charge or consideration. Provide this one, when I first got into this one really struck me as a little bit different because when it comes to sales tax, I mean, if you have tangible personal property in a state, that creates a link or connection. So that's going for sales tax, it's going to create nexus, but for income tax, you got to remember salespeople back in the 1950s, they were often given cars. And especially in the 80s, it was more likely they were given cars. Back in the 50s, maybe they were going door to door, walking. But in the 80s, they were definitely, a lot of industries provided, cars to their sales personnel. So providing automobiles to sales personnel for their use in conducting protected activities. If they're doing anything more in that car than protected activities, then it's not protected. All right, so here's one. Passing orders, inquiries, and complaints into the home office. Um, a lot of times as salespeople, we get involved and we talk about when we get to the unprotected activities, we're going to go into that one in a little bit more detail. Missionary sales, these are activities that you're doing on behalf of one of your customers. Coordinating shipment or delivery without payment or other consideration and providing information relating thereto, either prior or subsequent to the placement of an order, without payment or other consideration. If you're getting paid to do that, it's not protected. All right, checking customers' inventories without a charge for reorder, but for not for other purposes is quality control. So if you got someone going in there and they're looking at dented cans, that's not a protected activity. So if you're just checking inventory for reorder, then that is a protected activity. Any quality control associated with that is not. Maintaining a sample or display room for 2 weeks. That's 14 days or less at any one location within the state during the tax year. Very, very granular there. 14 days, they say. Um, if it's more than 14 days, it does uh, not offer you any protections. All right, so recruiting, training, or evaluating sales personnel, including occasionally using homes, hotels, or similar places for meetings with sales personnel. All right. They were very specific in a lot of those, very granular. So let's look at these unprotected activities. And this first page here looks a lot like the activities of third parties that I showed earlier today, making repairs, providing maintenance, collecting current or delinquent accounts, investigating creditworthiness, installation or supervision of installation, at or after shipment or delivery, conducting training courses or lectures for personnel other than personnel involved only in solicitation. Real granular there. Installation or supervision of installation. A lot of times I'll ask someone, well, do you have anyone doing installations? Well, no. And then I'll look at some of their invoices, over the course of the project, and they'll be getting paid. And I'll ask a question and I'll say, well, what is this? Oh, well, we don't do the actual installation. We just supervise it. Well, the states look at that the same as installation. So that's not going to be a protected activity. Providing any kind of technical assistance or service, including but not limited to engineering assistance, design service, when one of the purposes thereof is other than making a sale. Investigating, handling, or otherwise assisting in resolving customer complaints. This is the one that I said it's hard to keep a salesperson from not helping on this stuff. Well, if they're doing it for it says here, when the sole purpose of such mediation is to ingratiate the sales personnel with the customer. Well, how do you distinguish that? I mean, why else would a salesperson get involved in trying to mediate problems? I think they want to do it to make themselves look good with their customer. But if they're doing it for any other reason, then it's going to not be protected. Proving or accepting orders, well, yeah, that says it right in the law. Repossessing property, securing deposits on sales, picking up or replacing damaged or returned property, hiring, training, or supervising personnel other than personnel involved only in solicitation. And then using agency stock checks or other instruments or process by which the sales are made, and maintaining a sample or display room in excess of 2 weeks. And 2 weeks is 14 days. So if it's greater than 14 days at any one location during the state, during the tax year, then that is not protected. So these are the protected activities that the MTC has historically put out, and companies have followed that guidance. And companies have relied on that guidance. States have followed that guidance. Not so much anymore. The MTC came out on November 20th. The MTC Executive Committee adopted revised guidance, and on August 4th of 2021, the MTC adopted this revised guidance. And at least 22 states at that time said they will adopt this new guidance either in full or in part. And here are some of the points of this revised guidance. Providing post-sale assistance to customers via either electronic chat or email access through a website link. The business solicits and receives online applications for its branded credit card via the business's website, inviting viewers of a website to apply for non-sales employment. I mean, you don't even have to get any applicants in the state. If you just have that on your website, then the MTC is saying, well, sorry, you're not protected by Public Law 86-272. Inserting internet cookies into the computers or other electronic devices of customers. How many websites out there today do you see that don't use cookies? The business offers and sells extended warranty plans and then remotely fixing products via the internet and Wi-Fi. We're seeing more and more of this today. So the MTC has virtually gone out and they have gutted the protections of Public Law 86272. Um, or they're providing guidance for the states if they take this into consideration for the gutting of Public Law 86272. Now, this is a federal law, so we don't know what the final outcome is going to be. We know that the states are going to be pushing there. I think that we'll get some sort of pushback. I think we're more likely to see Congress step in here than on with the economic nexus because they've already spoken on this. So maybe they'll step out and say something again. Or maybe someone will sue them and it'll go to the Supreme Court and we'll get a favorable decision. But until either one of those things happen, I think that we're going to see more and more states get more and more aggressive. And right now, we have California, New York, and New Jersey who have officially adopted this new MTC guidance. Now, a lot of people say, well, there was a lawsuit in California, it got slapped down. No, not on the merits of the case. It was just, the way that they were doing something got slapped down. So California is still moving forward with this. They still are pressing forward with this new guidance. New York is doing it, and New Jersey is doing it. So we've got to look out for those states. Minnesota has floated proposed guidelines. Um, they haven't officially adopted yet, but they floated it. Hawaii, they're not following the new guidance. They just say, you know what? If you have an economic nexus here, we see that as a substantial nexus. It's the same as having a physical presence. So therefore, the protections of Public Law 86272, they don't apply. So you have 200 transactions in the state of Hawaii, and you could be subject to their income tax. And we think a lot of other states, 22 states have told us that they're going to be following suit. So we think that these are just the first of many to follow. Ellie, want to go to the next poll question?
Absolutely. This is the last poll question that we have today. We just want to know if you're joining us for next week's webinar. So hopefully we see you there and hopefully we see you at all future webinars. But Mike, you can move forward and then we will leave this open for a little bit.
I like these choices. It used to be yes or I will do my best. There was no in there. I see that we added a no. I like that. Got to give people all the options. So we have a couple people who are not joining us. I hope it's not because they don't like me. But we try to do our best here. So let's do a little bit of a wrap actually, let's talk about economic nexus for income tax. Quill, as we mentioned earlier, because of that limiting language, they led to the states asserting economic nexus for income, franchise, and other taxes. Then we talked about Jeffrey. They really started pushing the envelope in 1993. They said that the licensing of intangibles would create nexus. And then the MTC introduced a factor presence nexus standard, and we'll go over what that is. And when you have an economic nexus, in theory, you still have to follow Public Law 86272. That's the states should be following that. All right, so the factor presence nexus model. The MTC came out in the early 2000s. They said substantial nexus is established if any of the following thresholds is exceeded during the tax period. And it was a dollar amount of $50,000 of property, or a dollar amount of $50,000 of payroll, or a dollar amount of $500,000 of sales, or 25% of total property, total payroll, or total sales. Now, we'll go over some of the states that have implemented this exactly or some version of this. But I want to make the point, the MTC is making a hard push for any state that adopts their new guidelines. They want them to use this as a protection for small sellers. This is their small seller protection as they're pushing for changes um, for the states to make changes to their Public Law 86-272 guidelines. Now, right now, this is not an exhaustive list, but here's some examples of economic nexus for income tax. In Alabama, the threshold is 500,000. And remember, guidance by the MTC, it's not binding. So states can use any version of it that they want or make modifications to it. A number of these states or cities adjust for inflation annually. So California started out at 500,000, but it goes up every year. Colorado, 500,000, Connecticut, 500,000, Michigan, 350,000, New York, 1,138,000, Ohio, 500, Tennessee, 500. Now here's a tough one. Virginia, $1, because they say any positive apportionment factor. So if you have $1 of sales, that's a positive apportionment factor. So in theory, $1 in sales in Virginia could subject you to their economic nexus for income tax. Now, we're going to talk about materiality, the last thing we're going to talk about today, and we'll bring this back up. Washington, it's 100,000. Texas, 500,000. Oregon, you trigger it at 750,000, but you don't have to start filing until $1 million. Philadelphia, 100,000. And then Pennsylvania is going to be 500,000. And as we mentioned, New Jersey and Hawaii, 200 transactions or $100,000. Bear with me one second. I hear lots of noises in the background. Sorry about that. I don't know if you could hear it, but it was driving me crazy. All right, so states where Public Law 86-272 doesn't apply or doesn't fully apply. So remember, we said that the Public Law 86-272 only applies to net income taxes. Well, the first group of states here, this is per their guidance, California, Hawaii, New Jersey, New York. They have said that Public Law 86-272 doesn't apply anymore. If you violate any of the things on the new guidelines from the MTC for California, New Jersey, New York, Hawaii says if you have nexus in Hawaii, you have nexus for sales tax and for income tax for the same reasons. Kentucky, the limited liability entity tax, not a net income tax. And people hear limited liability and they think of LLCs, and it's not. It's anyone but like a general partnership or an individual. I mean, this covers C corps. It covers just about any type of entity out there that will limit an individual's liability. So it's not a big tax. It's more of a pain in the neck. I mean, minimums are on that one, and a lot of our clients end up paying the minimums because they're not, deploying a lot of property inside the state. It's $175. The Ohio Commercial Activities Tax, or CAT, this was a bigger issue. I think effective this year. It's $3 million, but it was $500,000 for quite a while. You got the Nevada Commerce Tax. That's a $4 million threshold. The Oregon Corporate Activity Tax. Oregon, they said, well, we want some of this remote sales revenue. They don't have a sales tax, and they looked at Public Law 86-272 and said, well, they don't have to pay our income tax, so we're going to create a new tax. Since Public Law 86-272 doesn't protect a gross receipts tax, we're going to incorporate one. So we're going to get you coming or going. So I think we're going to see more of that. The Texas franchise tax, not a net income tax, so that's not protected. And then the Washington business and occupation tax. These are just some of the major taxes that you're going to run across. Definitely not an exhaustive list. Now, here are some of the aggressive states. California, probably the most aggressive out there, especially when it comes to Amazon sellers. Um, you know, uh, the Franchise Tax Board has gotten a list of people who have inventory in the state of California, and they're going back after these companies. Now, they're only back to the year 2019. They started in 2018. Now they're at 2019. And California is so backed up. I mean, when you're trying to straighten things out with the Franchise Tax Board in California, it's going to take you like 2 years. They'll cash your check, but they won't process your returns, you know, forever. So it's really hard to work with them right now to get a number of our clients caught up, and they'll keep sending nasty letters after they've cashed your check. So, got to constantly beat them back. Pennsylvania, they also are going after FBA sellers. Now they got in trouble. There are courts in Pennsylvania said, "Hey, you've overstepped." But that's for sales tax. For income tax, they're still pursuing people. Florida, a lot of people say, well, there are no taxes in Florida. Well, there are no personal taxes in Florida. So if you're in an LLC or an S Corp, then you don't have to worry about it. But Florida is extremely aggressive when it comes to C Corps. Illinois automatically opens up an income tax account for you. Puerto Rico to Nebraska. South Carolina, another one that automatically opens up an income tax account for you if you're a C Corp. And then Texas and Kentucky, same thing. They're automatically opening up income tax accounts for you. In Texas, it would be the franchise tax, not the income tax. So what does the future hold? These are my opinions. I see more states are going to follow Oregon's lead and introduce maybe not gross receipts taxes, but other taxes to get around Public Law 86-272. We are going to see states try to chip away at protected activities. Massachusetts says that in light of Wayfair, Public Law 86-272 is unconstitutional. At some point, maybe they'll act on that and try to put a case together that goes to the Supreme Court. The MTC, we talked about them revising their guidance, and many states are going to be following. FBA sellers are already a target. California has been very aggressive. Pennsylvania has been aggressive. And we're going to see states become more and more aggressive pursuing income, franchise, and gross receipts taxes over the next 36 months. I think that this is going to be the next big battle for e-commerce sellers. I mean, we're 6.5 years past the economic nexus. That was the start of a battle. The states are starting to get their arms around it. They're really going to become aggressive on that to make sure that the last 50% of companies out there or so start towing the line. And then I think they're going to shift their aim and go after companies for income tax. So I think that's what the future holds. Here's an income tax nexus summary. Public Law 86-272 offers limited protection. Most states are still following this, but in today's economy, companies that actually have protection that aren't offering services in addition to their sales of tangible personal property are not that many. Activities that exceed Public Law 86-272 are going to create nexus. Public Law 86-272 may change. Right now, we have guidance saying interpret it differently, but the law may actually change. And we have to worry about not only physical nexus when it comes to income tax nexus, we also have to worry about the economic nexus, and that's since 1992, not since 2018. All right, let's talk about a couple of other things. Secretary of State, a a lot of people think that you automatically have to get registered with the Secretary of State, and that's just not so. Now, one of the reasons they think this is that many of the websites, the state websites, not the Secretary of State websites, but the Department of Revenue websites, make it look like it. And if you're trying to do a sales tax registration, um, they or even an income tax registration, it makes it look like you got to get registered with the Secretary of State first. And you may have to do that in certain circumstances, but in general, especially if you only have an economic nexus, there's a workaround in just about every state. You just have to know what that workaround is. You don't have to get registered with the Secretary of State in all scenarios. And for those companies that, e-commerce companies, very few scenarios where you're going to have to get registered with the Secretary of State. You could have Nexus for sales tax and not be transacting business for the state Secretary of State guidelines. Same thing with income tax. You could be transacting business in a state you could have Nexus for income tax, but not be considered transacting business for the Secretary of State. Now, there are more instances for income tax where you might have to be registered with the Secretary of State than sales tax, but still not every time. All right, so let's go over some common myths. Registering for sales tax creates income tax nexus. And one of the things we hear, we know that 50% of companies or so, rough number there, are not compliant for sales tax. And one of the excuses we hear is, well, I don't want to have to mess with all that income tax. Well, registering for sales tax does not create income tax nexus. Now, it may put you higher up on the state's radar. You're registered for one type of tax and not for the other. But sales tax nexus and income tax nexus, it doesn't create nexus for income tax if you get registered for sales tax. Now, if you get registered with the Secretary of State, that could, in some states like Florida, create nexus for both sales tax and for income tax. But registering for sales tax doesn't require you to register with the Secretary of State. And it doesn't create income tax nexus. Now, some states will automatically open up an income tax or franchise tax account for you. Then you have to go to those states and get them to close it, say that you don't have nexus, explain why, fill out some forms, makes it a pain in the neck. Other states like Illinois will say, hey, we opened this up out of the goodness of our heart. I mean, if you ever get subject to the Illinois nexus tax, then Illinois income tax, then you have an open account. That makes me real nervous. I don't like having open accounts, and I don't think the states do anything out of the goodness of their hearts, but hey, that's just me. Sales tax registrations require SOS registration. We talked about this already. Wayfair creates income tax requirements everywhere. No, absolutely not. There are nexus rules in just about every state out there. Just because Wayfair passed doesn't mean that you have a requirement to pay income tax everywhere. Now, some of the same activities that create nexus for sales tax will create nexus for income tax, but just because, especially if you just have an economic nexus somewhere for sales tax, most of these states still follow the protections of Public Law 86-272. So the exact opposite is here. In most instances, based on where states are today, you do not have income tax requirements everywhere. And then I need to register everywhere I have Nexus. This is a big issue. I talk about this all of the time. And this is where materiality comes in. I think that just because a state says you should do something doesn't necessarily mean it makes common sense to do so. For example, if the cost of compliance exceeds the back tax plus penalty and interest, does it make sense to file? To me, the answer is no, it does not. Now, sales tax is going to be material at lower numbers. So I think if we're concentrating on anything, we need to concentrate on sales tax because our exposure is much greater there. And the reason why is sales tax is going to be based upon your gross sales, where income tax is generally going to be based upon your net income. So let's say that you get $100,000 of sales in a state. Let's use 10% to make the numbers easy. If the sales tax rate between the local and state equals 10%, you're going to owe $10,000 before any penalties and interest. Whereas on the income tax, you got the same $100,000 of sales. Let's say you got a 10% profit margin. That's going to be what your net income would be. Now, there's apportionment formulas in every state. We're not going to get into that. We're just going to keep this simple and assume that it's going to work out so that 10% of $100,000 is $10,000. That's what's going to be the basis for the tax. And again, if the tax in the state is 10%, and some states are a lot lower, some states are higher. Now we're talking about $1,000 in exposure versus $10,000 of exposure. So you definitely want to make sure that you're taking care of your sales tax issues prior to taking care of your income tax issues because you're going to have much more exposure on the sales tax side than the income tax side. The bigger you get, the bigger your problems on the income tax side are going to be. Now, when it comes to sales tax too, here's another thing. The income tax is always going to come out of your pocket or your client's pocket. But when it comes to sales tax, that should be coming out of your customer's pocket at the point of sale. To me, that's the greatest tragedy in the sales tax. I mean, something that someone else should have been paying now I got to pay with the added insult of penalty and interest because I either didn't know or I chose not to. And a lot of people know, but choose not to. A lot of people just don't know. So um, that's a big reason we should be concentrating on sales tax. And then the cost of compliance is generally lower when it comes to sales tax than it is when it comes to income tax. There are a lot of companies out there charge $50, $55 a return. Some of them, have single fee pricing where when it comes to income tax, you may be paying $1,500 or more per return. Now, there are less of those a year, but if you're going to owe a state $750 or $800 or $1,000, and it's going to cost you $1,500 to file that. Does that make sense? I mean, the cost of compliance exceeds the back tax, even at penalty and interest. 3, 4, 5 years down the road, you got to be doing this every year. So the cost of compliance keeps adding up. It just, to me, I think we need to use common sense. Now, I am a huge believer that if our exposure is material, then we need to be getting registered and we need to either be collecting and or paying the tax. I'm not saying ignore your taxes or let your clients ignore their taxes. It's really important. I mean, some of the penalties I see and the back taxes can put companies out of business when we're talking about sales tax and sometimes income tax. So I'm not saying to ignore sales tax or income tax. What I'm saying is make sales tax the priority and we need to look at materiality. Okay. If it's material, then register. If it's not material, and a lot of people say, well, what's material, Mike? Well, if it wouldn't leave you a black eye if the state finds you, then that's generally not going to be material. So it's we just need to be using common sense. Is it going to cost more to be compliant than if the state found us? That's the bottom line. All right, Ellie. Do we want to open it up to questions?
Yeah, we have a couple questions here, and if you have any questions that you haven't sent in the Q&A, please send those over. Okay, Mike. So the question is, what about a business owner who operates in an origin-based sales state like California? Would that business owner need to be concerned about Nexus since their sales tax is origin-based?
Yeah, and unfortunately, there's a lot of the software companies out there that make a big issue out of origin based. Um, so sales tax is only origin based if the entire transaction is within the state. Whenever a transaction crosses a state line, it's not origin based, and this is in every state. It's going to be destination based. So the only time we're really talking about origin based is with local taxes. So if you're shipping things into other states, it's based on destination and not on origin. We never look at origin except if a state is 100% within a state. It's originates in the state and terminates in the state. But if you're shipping to any other state, and that's where your customer is, or even if your customer is not there, if that's where your customer is asking you to ship, that sale is considered to be sourced to that destination state. And if you cross the thresholds, either the dollar amount or the transaction amount in these other states, then yeah, you would have a responsibility to collect and remit tax there if your sales are taxable.
All right, thank you, Mike. Okay, next question. Does a FBA seller have to pay income tax in any state where their inventory is stored?
A little bit of a trick question here. Um, they don't have to pay income tax. Not every state is going to consider that to be um, nexus creating, but in general, the state can come after them. There is no protection from Public Law 86272. So California, extremely, extremely aggressive. Pennsylvania is aggressive to a lesser degree. Texas, while the inventory in the warehouses doesn't create nexus for sales tax, it does create nexus for the franchise tax. So the states may not be coming after FBA sellers at this point, but I think that they will. And one of the problems with marketplaces, once the marketplace starts collecting the taxes, most of the states have written into their agreements, or most of these marketplaces have written into the agreements that um, you know, the states may request whatever information they need in order to determine that taxes are being paid correctly. So that's why you see Amazon turning over their customer list and who's got inventory where to these states. And that's how California is so accurately following up on all of these FBA sellers. So um, has to pay is a pretty strong term. Maybe liable to pay is a term I like better. And just about any state out there, I think, could come back and say, yeah, uh, we want the income tax. Now, they may not be that aggressive now, but I think over the next, you know, 2, 3, 4, 5 years, we're going to see more and more states become more aggressive when it comes to income tax. Now, it all depends on the size of company you are. Just like when we talk about materiality for sellers, states want to look at materiality too. So if you have $10,000 of sales into a state and the state knows that, are they going to really want to spend their uh, capital, their time, their money, their resources trying to track you down? It would cost them more to get the money from you than the amount of money that they're going to get. But any of the large sellers out there, you get $1 million of sales in a state. I think that, these states over the next 2, 3 years here, it's going to be the next big battle for e-commerce sellers. You dodged a bullet when it came to sales tax because the marketplaces are responsible for it, but it makes it easier for the states to come after you for income tax at this point. Any
All
other
right,
questions, Ellie?
that's it. Thank you so much, Mike. Thank you everyone for joining us. Please remember you have to fill out that survey in order to receive CPE credit. And Mike, you can close it out.
All right, so I just saw another question come in. Can I ask you to clarify my question about origin-based versus destination-based sales tax states? So does that distinction only apply to local taxes? For in-state sales, for all out-of-state sales, is the tax considered destination-based, and therefore, no matter where you operate, you have to consider nexus for out-of-state sales? Absolutely. Yeah. You've repeated it back correctly. It doesn't, origin, unfortunately, it's misleading, and the software companies make such a big issue out of the term origin when you're setting up their sales and everything else. I've had multiple people tell me, well, Mike, I don't need to collect tax because I'm in an origin-based state. And unfortunately, it just doesn't work that way. If you're in an origin-based state, it only has to do with what local taxes you need to pay, rather than paying taxes to other states. Every state out there looks at destination as the source of the sales. So if you're shipping into other states, yeah, there's a responsibility there, if you have nexus, and what you sell is taxable, to collect and remit the taxes.
All right, Mike, why don't you close us out?
All right. Well, thank you, everyone. I hope that this has been beneficial here, and we hope to see you on the next webinar that we do. And if you have any questions, just reach out and we'll try to help them get them answered for you. Take care. Bye-bye.